Hey everyone, welcome back to Corporate Decoder. Today, Richtech Robotics Inc. RR just filed its 10Q report for the quarter ending the 31st of March 2026, and I am seeing some interesting shifts in how they're handling their business. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is all about robots and AI trying to make businesses more efficient. But this filing shows they're navigating some pretty big changes, especially with how they make money and how they're spending their cash. Let's dive into the numbers. On the 31st of March 2026, Richtech had about $383 million in total assets, which is a good jump from around $273 million at the end of September 2025. Most of that growth is coming from their cash and short-term investments. Their cash and cash equivalents alone jumped from about $185 million to over $250 million in just 6 months. That is a nice chunk of change, and it means they have breathing room. But here is where things get interesting. For the 6 months ending the 31st of March 2026, they reported a net loss of over $10 million. Now, that is actually better than the nearly $30 million loss in the same period last year, so they are narrowing their losses. A big reason for that improved net loss is investment income. For the 6 months ending the 31st of March 2026, they raked in over $6.7 million from their investments. That is way up from just $720,000 in the prior year. It seems like their cash pile is earning them some serious money. They also had a gain of about $375,000 from changes in the value of their warrant liabilities. This might sound technical, but basically when the value of these warrants goes up or down, it impacts their reported profit or loss. Last year, they had a huge loss here. Over $21 million, so this year's gain is a big relief on paper. Let's talk about revenue for the 6 months ending the 31st of March 2026. Their total revenue was about $2.6 million, a small increase from $2.4 million in the prior year. Within that revenue, product sales are down significantly. They went from $1.4 million last year to just $600,000 this period. This shows they're really shifting away from just selling robot hardware. On the flip side, event services revenue is way up, nearly doubling from $424,000 to $889,000 for the 6-month period. This makes sense as businesses might be renting robots for shorter events rather than buying them outright. Their robots as a service or RaaS model is also growing fast. Revenue jumped from $245,000 to $690,000. This is likely their future as it provides a more predictable, recurring income stream. With all these shifts, their cost of revenues also went up by about 50%, from $1.2 million to $1.9 million for the 6-month period. This is mostly because the cost for their growing event services and RaaS are increasing. This all leads to a drop in gross profit for the 6-month period. It fell from $1.2 million to $700,000. Their gross margin also took a hit, dropping from nearly 49% to about 27%. This is a key area to watch as they scale up their service offerings. They are pouring money into research and development as expected for a robotics company. R&D expenses more than doubled for the 6-month period, going from $804,000 to $2.2 million. They're investing heavily in AI and making their robots smarter. Sales and marketing expenses also saw a big jump, mainly due to a large one-time stock-based compensation award given out in the first quarter of 2026. Without that, the increase would have been much smaller. This suggests they're trying to incentivize their sales team. General and administrative expenses also increased quite a bit, especially for the 6-month period, going from $8.8 million to $12.5 million. A chunk of that increase was also due to stock-based compensation and an allowance for credit losses, meaning they're setting aside money for potential bad debts from customers. Looking at cash flow, they used about $2 million in operations for the 6 months ending the 31st of March 2026. That is an improvement from nearly $5 million used in the prior year. The reduced net loss is helping here, even though they are still using cash to run the business. Financing activities, however, brought in a lot of cash. They had over $113 million provided by financing activities for the 6 months ending the 31st of March 2026. This is a massive increase from just $16.8 million in the prior year. This big cash inflow comes mainly from selling shares. They raised over $110 million by issuing new shares. This aligns with the news that they've been doing share issuances to boost their cash. Specifically, in January 2026, they closed a private placement, raising about $35.9 million by selling 8.5 million shares of Class B common stock. This private placement is a significant event showing they can still attract investor capital. Now, let's talk about warrants. These are like options to buy stock. They have several types of warrants and some are classified as liabilities because of certain terms. As of the 31st of March 2026, they had over 1.7 million liability classified warrants outstanding, down from over 5.7 million at the end of September 2025. The decrease is because many of these warrants were exercised. The valuation of these liability warrants is complex, using models like Black-Scholes, and it depends heavily on assumptions like stock price volatility. When the stock price swings, the value of these warrants changes, impacting their earnings report. They also have warrants classified as mezzanine equity, which is a bit like a hybrid between debt and equity. These are also a key part of their financial structure. When it comes to stock, they have Class A and Class B common stock. The number of authorized Class B shares was significantly increased in late 2025. As of the 31st of March 2026, they had over 184 million Class B shares outstanding, up from about 154 million in September 2025, showing a lot of new shares were issued. Stock-based compensation is a big expense. They have a stock incentive plan, and in the 6 months ending the 31st of March 2026, they recognized over $8.5 million in stock-based compensation. This is a non-cash expense, meaning it doesn't directly impact their cash flow, but it does dilute existing shareholders' ownership. Looking ahead, there are some significant subsequent events. On the 1st of April 2026, they agreed to buy a building for over $21 million. This shows they are investing in their physical infrastructure. Also, in January 2026, they started a major internal transformation called AI across all to make their systems AI native. This is a big strategic move that could impact their future investments and how they account for their intangible assets. Like software, they're planning to write off or amortize certain older software assets as they transition. Now, let's touch on the legal side. They are facing a couple of lawsuits. One is a breach of contract case where the plaintiff is seeking over $600,000. They also have a securities class action lawsuit related to a press release from January 2026. And there are derivative lawsuits filed by shareholders against officers and directors. The company believes these claims are without merit, but these legal battles can be costly and distracting. It is also worth noting their internal controls. Management has concluded that their disclosure controls and procedures are not effective. This is because a material weakness in financial reporting hasn't been fully fixed yet. They are working on improving controls over complex transactions and financial statement accuracy. This isn't uncommon for growing companies, but it does mean there is a higher risk of errors. Overall, Richtech Robotics Inc. is in a period of significant transition. They are reducing their reliance on hardware sales, growing their recurring revenue streams through RaaS and event services, and making substantial investments in R&D and infrastructure. They've also successfully raised a lot of cash through share issuances and private placements, which is a positive sign for their ability to fund operations and growth. However, they are still operating at a loss, dealing with complex financial instruments like warrants and facing legal challenges. The key thing I'm watching is whether their shift towards RaaS and services will truly lead to sustainable profitability and improved gross margins. The increased investment in R&D is crucial for staying competitive in the AI and robotics space. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord.